Good morning, ladies and gentlemen. My name is Roger Scott, and I'm the Senior Strategist of 𝗧𝗴𝗀, and I want to welcome you to the Midweek Roundtable. We got our usual co-host, 𝗧𝗴𝗀𝗀. He's the Senior Strategist for Joy of the Trade. If you want to reach out to Jeff, if anything, and I highly recommend you take a piece of paper and a pen and take notes, because this is not scripted. This is going to help you get inside the market the right way, understand our dynamics, understand how we analyze the market action, and how we look at the market from a macro perspective. So take a piece of paper, write it down, and if you have a question, reach out Jeff at Joy of the Trade. Jeff at Joy of the Trade. My email, support@marketgeeks.com. It's an old email. I've been using it forever. Things will get there. Jeff, how are you doing today on this wonderful, beautiful
well,
Wednesday?
Roger. How are you?
I'm doing great. It's interesting. You and I are in the same state. I'm in the upper northern part, and you're in the, almost all the way down to the.
You're getting chilly mornings already. I'm a little bit jealous of that. I like the chilly mornings for a change of pace.
A little bit. Starting to wear the long shirts and the pants a little bit. It is getting a little crisp. What's interesting is, it just shows you how much you get used to the living here. California has humidity of about 50%, 60%. Yesterday or the day before, it was Sunday, it was 78 degrees here and the humidity was 92%, and I did not feel it at all. I do not feel any humidity at this point if the temperature outside is below 80 degrees.
But you feel dryness. If you go to a dry environment, you feel totally dehydrated, your skin feels dry.
My skin it's
we could be, in another life. We don't have to be stock analysts. We could just be weathermen, you and I, the Roger and Jeff meteorological report.
Wouldn't that be something? I love it. Don't give me any funny ideas. My wife is listening. She's going to get me have another job after this. So Jeff, I know the market's been, we're entering earnings. We had the CPI this morning. We haven't really got into anything. We haven't really talked about the markets at all since the last time we were here, aside from just a few slacks here and there. What are you seeing? What's going on? What are you making of what's going on right now?
It's still a chop shop, isn't it? We'll have the market open up and spend half the day slightly up, maybe 50 basis points, 0.5%, et cetera. And then in the last 2 hours, just this big sell program comes in and knocks the market down 1% or takes all the gains and goes down another, 0.5%. And so the market's kind of skittish to me. We're in this weird zone where nobody knows what to make of what the next shoe to drop is going to be. The thing you point out, which is incredibly true, is we're still in a bull trend. And, I've been overly bearish for myself, and merely from a standpoint of certain pockets of the market, certain pockets of exuberance and bubblish type of froth. But I think generally speaking, it's going to be a continuation of this after we get this. And so I think we're in this weird spot where the market, it would behoove the market to have a good, another 5% puke or so, and then move on from there. I feel like we're kind of in this limbo place. And that's because there's just so much money on the sidelines that comes in and tries stuff, but it's still not overly healthy.
I agree with you. And you're absolutely right. I call these levels, the level between the 50-day moving average and the 200-day moving average, I call it the twilight zone.
Yeah.
That's my nickname.
Perfect.
Yeah, because we're in no man's land. We're kind of not. Yeah, I've nicknamed it that many years ago, and it's just kind of this level where there's just not a lot. I call it the perfect environment for selling premium, actually.
It is the perfect environment for selling premium, but it's just it's so tricky. First I'll be the last. From one day to the next, they start buying Chinese stocks for no reason, and they puke them again, and then you can't stocks have a reversal at the end of the day, and then they come back the next day. It's a very maddening tape for professionals and amateurs alike. It's a really difficult type of market.
I'll tell you the only clear trend I'm seeing right now, and this has been a very clear trend, and the clear trend I'm seeing is the fact that the small caps are finally starting to, they're holding up a lot better than the large caps on a momentum level. And even this morning, this is not saying much because the 200-day line and the 50-day line on the Russell 2000 is this far away from each other. They've been very choppy. So the line, the market's been choppy. So the moving average is just hovering along. So they're next to each other. But with that said, The price action this morning was above the 50-day line on the Russell. Do you know the primary reason for that? There's actually a very simple fundamental reason for it right now.
Oh, give it to me.
And folks, don't make it more out of it, because this is just really what it is. Because the Fed is putting more pressure to raise interest rates. Right. Large cap stocks are much more sensitive to interest rates than small cap stocks. So the smaller stocks, the non-interest rate sensitive stocks, is where a lot of the money's been going instead of the large cap.
And the converse aspect of that, what's a knockoff of that, or I guess a symptom of that, is that the smaller cap stocks are more tied to the real economy. And a sign that the real economy is doing better is that interest rates are flowing higher. Yeah. So it's kind of like symbiotic. It causes the same result, but it's also a symptom of what's happening on the
Exactly. And I want to tell something people at home, and I want to get your take on it. But I've been doing some analysis. I've been doing some real deep analysis. Good. And this whole thing with interest rates is going higher, markets are going lower. I looked at this, and we kind of talked about this kind of in a roundabout way, but generally speaking, historically, when interest rates are this low and they're getting higher, it's not signaling a down market. It's actually signaling a very bullish market. It's when interest rates go higher, when they're high, is when we start coming down. But every time, Jeff, we've had interest rates come off from lows, for a substantial period of time, we've actually gone higher. And because look, it's an expansion of economy. We're expanding. Right. So I'm not nearly as so I'm also looking at that at this rates are going up, stocks are going down. It's not always that simple. And folks at home, remember, interest rates are near zero right now. They're not that high to begin with.
And it's not all stocks. Also, there's, like you said, small caps, financials, commodity. Right. There's a lot of stocks in the stock market. But the problem is if you're a very interest rate sensitive company that borrows a lot of money because you're fueling growth, that's where the problem lies a little bit. And so you gotta look at your portfolio. I mean, there's still the same host of geopolitical problems. I think that the economy is expanding, but I think that inflation is gonna be a real problem. I know I'm an inflationista, and I've been banging the drum on energy creating pain. And I don't even think that this move in energy is the pain move yet.
We're not there yet.
I think we're going to have a crazy 25% in a week move, and people are going to start panicking type of move, where the Fed is going to not be able to put their head in the sand and say, "Oh, it's transitory. It's transitory." They're not going to be able to hide from this. I was listening to a really smart guy on one of the talking head financial stations that should remain nameless this morning. He made a very good point. He said, "Listen." And he owns a bunch of hotels. He's a hotel, that's his main business. Mm-hmm. And he's like, I can pass through my price pressure to everybody and they still pay. I can charge whatever I want for a hotel per night and I'm still selling out. That tells you that inflation has a lot more room to grow. That has a lot more room to grow because there's so much cash. People are flushed with cash right now. Right. And this reset for the lowest end people is going to be really, really tough. Somebody else was saying, "Oh, I had to go fly and I had to get a quick PCR test. It cost me $160." Well, for people, it means $160 is a rounding error. It doesn't really matter. But when you're on a super tight budget and you're raising a bunch of children and you're working 2 jobs, like a lot of mothers out there are, these things they're killers. Yeah, it's killer stuff happening out there.
I couldn't agree with you more. So let me ask you this: what are you thinking about China? I haven't really talked to you about China. You have a very good nose to the ground when it comes to China. Any updates, news, anything we should be looking at?
China's not really been. They haven't done anything new, which is good. So no new aggressive actions from the Communist Party in China is good. So the market has reset a little bit higher. Some of the stocks have come off the pressure that they've been under. But if you look at the longer term charts on a lot of these names, still incredibly bearish tape, going straight down. Some room to go a little bit higher to the moving averages, but all well underneath their moving averages. So no real reason to get bullish in any of these names yet. So we're trend followers. People don't understand that. It's that's hurdles. You actually have the opportunity to learn from some of these people. And the big thing is being trend followers. And those trends stay lower, bearish. Those and the fundamental reasoning behind them also stay firmly in place with China. So I'm waiting to see if there's more, if they come up with any new stuff in terms of pressure that they want to put on different companies, because I think they will. I'm waiting to see if they take more aggressive actions in Taiwan, which I bet they will. I'm waiting to see if they take more aggressive actions against foreign investment via Hong Kong, which I know they will.
Yes.
And so all these things are, the picture hasn't changed. It's just a pause.
Well, one of the things I was curious about, I read a report from Beijing last night about right before I went to bed, and it said China reports its exports jumped 28% in September, imports up nearly 18%, while surplus with U.S. rose to about 42 billion. So I wanted to kind of see if you thought that. I mean, obviously, we have to take this kind of news from China with a very, very big grain of salt. But my concern is the supply chain bottlenecks, because, as you know, we import a hell of a lot of things from China. They're our largest importer, or exporter. So
right.
so my concern is, do you think this wrinkle that we're having with China and with all the global economy kind of stagnating, do you think it's going to eat into the supply chain for the holidays in the U.S.?
I do. And I think that we're going through some weird global macro transition period where China can no longer be counted on as the global engine for GDP growth worldwide. Not only from an export standpoint, but from a consumption standpoint. Producers have been depending on Chinese building new cities, that all the agrarian farmers are going to, everybody's going to leave their farm in rural China and take up life in the big city. Well, that never happened. They're like bombing cities to destroy them. That's why Evergrande is in the situation they're in.
Right.
They're having a real estate crisis in China. So they have a growth problem in China domestically, right? So what does that mean for the rest of the world? Well, that is playing itself out, which is why you still have to be relatively very bullish on United States, US equities versus China in particular, and Europe for that matter. Europe's actually more dependent on Chinese growth than the United States, because a lot of their great companies are giant conglomerates. They're like metals conglomerates, et cetera. Auto companies, et cetera.
Just from a logistics,
they need it.
Just from a logistics perspective, it makes perfect sense. I mean, you don't have to go across. It makes perfect sense.
Both are dependent on foreign energy as well, which is going to be a problem. So I'm bullish. I'm more bullish on the U.S. vis-a-vis Asia and Europe than I've ever been, but I'm slightly bearish in the interim, if that makes any sense.
It totally does. Yeah, because right now there's just not a lot of data to make heads or tails of, and usually when that happens, we see a little softening. One interesting factor is the fact that U.S. is actually is actually moving a lot of. I think the U.S., especially the electronics market, is wise to what's going on with China, and I think that I think we're going to see a lot more chip production flow outside over the next few. We're already seeing it right now.
Oh yeah.
But what I'm curious about is where they're going to find a new home. They tried Vietnam for a while and it worked, and then the COVID. I mean, 6% inoculation in Vietnam. So we're going to have a lot of problems with a lot of the manufacturers, the shirt manufacturers, the clothing manufacturers moved from China to Vietnam during the COVID, and now they're having this the same problem.
Let's call it what it is, Roger. This has been human capital arbitrage for a long time. Why is
That's what it is? That's what it is.
Because they don't have the same intensive human rights standards that we have in the West. They don't have child work laws. They don't have minimum payment, minimum wage.
Right.
They don't have wage guidelines. They don't have any of these things in place. They don't have conditions. Like, you don't have to provide certain. You know why Foxconn was so? Foxconn, for those people that don't know at home, was this legendary manufacturing facility where the iPhone was first mainly produced. And the reason it was so popular was Apple could give them like an initiative and say, we need millions of these units created in the next 48 hours. And you know what they would do? They would create these these army style bunker facilities where people would literally be sleeping in bunk beds, like in rows like that, and working 19-hour shifts and sleeping 4 hours to create this phone under incredible short time constraints.
Amazing.
So the point that I'm getting at is the human arbitrage, thankfully, another thing of technology, is going to disappear. We're going to see more and more automated robotic manufacturing. And I predict that anywhere that you have like cheap land to create a facility is going to be much more important than having no labor laws.
Agreed. I agree with you. I couldn't agree with you more. And by the way, I don't know if I just want to remind people that you and I were talking about crude oil on this show when crude oil was about $45, $50 a barrel, and we were talking about it going to 100. And now we're near what, the $80 level?
Yeah.
If I'm right around the $80 level, do you still believe? Sorry, I don't mean to change the topic on you, but I wanted to get back into
much higher than 100.
Much higher.
I think it can double from here. I think we're looking at like 150 maybe.
And Jeff,
what's changed is the fact that the Fed had a chance to act and to get ahead of this thing, and now it's totally out of control. The Fed is completely unrespected worldwide. They have zero credibility. They're under like humongous scandal, by the way. Like everybody's looking at Jay Powell and all these guys' portfolios.
Shameless.
It stinks to high hell. I expect a completely new entire board, Federal Reserve board, within the next 6 months.
You're singing my song, my friend.
And so they have zero credibility. A lot of these guys aren't even going to be there, and they missed their chance to react. So now we're kind of like a bus that doesn't have a driver. So where does that go? It goes much worse.
Much worse. And I've been talking to some of our analysts. I was talking to Matt. He studies the coal market. He's awesome. We usually have the world has so much coal supply. The coal supply in Europe and China is getting down to bare minimum right now.
Yeah, it's problematic.
Winter's coming. This is just all more fuel
Game
for
of
the fire.
Thrones. Winter is coming.
Yeah.
Winter's coming. You have to be bullish energy through the winter.
And not everybody lives in Florida, if you know what I mean. So, you know what I'm saying?
You have to be. You have to. There hasn't been a clean, so everybody's been, myself included. Look, I'm a proponent of clean energy. I am a big fan of having clean air and water for my children and myself.
Of course.
But I'm a realist. And that transition has been a bit clunky, frankly. And, people are looking at why did we abandon nuclear energy generators? It was the cleanest, most easily mass production of energy, and they just abandoned it because they couldn't correctly do it without calamities happening like Fukushima, et cetera. I don't know. I don't know what the answer is, Roger. There are people a lot smarter than me that are paid to study it, and they don't know either. But I know I'm bullish energy prices because it's not going to get solved anytime soon. We're going to still need oil no matter what. We're still going to need natural gas for a while no matter what. And these guys are going to be extortionists. OPEC is a cartel. They're going to extort the rest of the world. They're going to have a gun to the economy of the rest of the world. The only leverage we had for a few years was when we were producing in incredible ways, which is starting to slow down under the current administration. It's not their agenda.
No, it's definitely not their agenda. Let me ask you this: if you were a trader who is listening to this and you're thinking to themselves, "Hey, this sounds pretty good," how would you take advantage of the energy market right now? If you were if you were just a guy listening to this call, what would you do? How would you take advantage? Would you do it with a spread trade? Would you buy an ETF? Would you buy a top stock?
Look, again, there are different levels of risk tolerance. There are different timelines. But I'm broadly speaking, I think the energy drillers, which are typically higher beta, a little more volatile than traditional oil companies like British Petroleum and Exxon. If you're looking at the drillers, which are some smaller companies that are looking for oil, looking for natural gas, producing it, through fracking, through shale, et cetera. These guys north of $50 make a huge amount of money.
Right.
North of $100, these guys are wildly undervalued, still incredibly undervalued. And I think there could be the mother of all squeezes in those stocks. I think that ETF, the 𝗧𝗶𝗺𝗏, if you want a nice basket of all these things, is a thing that everyone should have. I know I've talked to some people that are like, I don't want to own energy because it's against my philosophy. I was like, okay. But it's a low-hanging. It's an easy trade for the next 6 to 12 months. For me, it's the lowest hanging fruit.
And right now, some of the top, if you look at the Russell 2000, which is a great, Russell 2000 market cap less than 20 billion, some potential. Some of the top stocks right now are coal stocks and energy stocks. Energy, and energy. So you couldn't be more right. It's definitely happening. I'm curious. What I'm curious about is, It's kind of interesting because you have this demand with energy right now, but industrial and basic materials have kind of sagged off. Typically, they kind of move together because, industrial and energy, they're related. So what I'm curious about is I'm curious if industrial is going to start picking up the pace again, or if it's going to start happening next year. So that's kind of where I'm with that.
Yeah, I'm with
that can
you
give
on
it
that.
very strong. That can give it very strong support. I'm not a psychic, but in my opinion,
they run together. The correlation is very high. They run together.
And
It's a little
one
bit of a time lag.
And one sector that I'm kind of getting a little coolish on, Jeff, is the healthcare sector. Do you have any opinions on that? Are you looking at any healthcare stocks?
They just had like the biggest moment in the sun, right? The healthcare sector's been like front and center for 2 years. So
the expectations got a little high, The
expectations got a little bit high. There's not a lot of meat left on that bone. I like situations where I look at things and I say, I know that this is the environment now. And I know that based on the current environment, this stock could go to that. And if it gets like this, if the environment gets this much better, which is called the blue sky scenario, then the stock will be absolutely explosive. And I think the blue sky scenario for healthcare is in the rearview mirror, at least for the next 12 months.
I think so as well. I think I agree with you. I think the expectations were just got so high. The earning numbers are just so catastrophic, so catastrophically big that it's very hard for them to continue that momentum. And the expectations on healthcare were just crazy over the last 18 months. I mean,
what do you think about the semiconductor? I mean, like, I love your takes on the semis.
Chip stocks. I think I'll tell you what I think on chip stocks. I think we're going to have some. Fair weather issues with supply demand over the holidays. I think the numbers are not going to be as solid, and I think we're going to see a division between consumer discretionary and technology. I'm actually seeing. I'm seeing bullish chip stocks, but not super bullish. I think they're going to get it. I think they're going to take a choppy road for the next.
Yeah, I'm with you. I'm looking at the timing it in. I think that like they can get a lot cheaper in the interim because they're in a bearish way because the trend is bearish. But I think if you're looking, because it's a cyclical thing, I think if you're looking to hold something, if you're plotting to buy something, if we get like extreme bearishness, I think the semis should be at the top of your list because this is all this pressure to take the supply chain logistics out of China and create chips everywhere else, manufacturing them, is going to create like a like what I was talking about, blue sky situation for them down the road.
And folks at home, if you want to take advantage of semiconductors in a very, very, obviously not a risk-free way, but a reduced risk way, there's the SMH ETF. That's the semiconductor ETF. It has the biggest semiconductor companies, and you're literally buying 20 or 30 semiconductor companies in one shot.
You really want to do that, SMH. You really want to do that because like
volatility
I like to play them in money. I like to play them in money links because they're so, technology, the big drawback of technology is that you have a hard time protecting what you're good at because somebody else does it better sooner or later. And so that happens a lot, like in the chip sector. One day it's Intel, the next day it's AMD, the next day it's Micron, and it's like dueling pianos. So if you have the SMH, you're playing the broader trend of the sector, and you don't get that single stock risk if their one tune that they play goes out of style for a little bit.
Yeah. Definitely. Right now, especially with the uncertainty, with the choppiness, you don't want to put all your eggs in one basket. ETFs are generally speaking great for when we're in what I like to call the twilight zone.
This is the twilight zone, my friend.
It is definitely the twilight zone. Let me ask you: Are there any link trades that you're currently looking at that you're targeting? Anything you want to share with our viewers?
I'll give you broad brushstrokes.
Sure. That's perfect.
Specifics. It's not, I like to have my subscribers.
Absolutely. Just an idea, just a teaser, a taste.
Yeah. So I'm a little bit bearish on, and so this is an inflation. This is an economy, inflation, logistics thematic. I'm going to give you. I'm a little bit bearish on retail, on the retail ETF going into the holidays because of the disruptions. I think it's going to impact the bottom line. I'm bullish on the miners because I think the inflation thing goes wild. So miners kill it. I think retail might be a little bit disappointing. They're also priced, pretty high and expecting, especially a lot of like the crappy brick and mortar retailers expecting like amazing foot traffic and everybody to spend all their money at the store. And I think the store is going to be empty in a lot of things. So I think that's going to impact them. So long story short, that's what I'm playing.
I'm actually, I'm not exactly the same theme, but I'm actually very, very bearish on some of the Las Vegas stocks again. The Las Vegas hotels like Sands and.
I've been bearish on those. They've been hurting me. I haven't been good at timing them full Monty. Like frankly, I've been okay sometimes and then bad sometimes because they've been like one of these like they've been one of these meme stock type of plays where like it doesn't make any sense if people come in and try to make a quick buck from the long side.
Right.
Long term, though, they have big struggles.
Yeah, I'm not seeing anything positive. I mean, you and I
are companies that depend on China.
Yes,
they depend on China.
Absolutely. The amount of gamblers that come out of there. Oh God.
Macau dwarfs Las Vegas. People don't know this, but it's like 70. It's like 3 times the size of Las Vegas in terms of gambling dollars. Now, Las Vegas is big for entertainment, shows, nightclubs, restaurants, the whole thing. But purely like gambling action, which
the VIP room in the back of the back room,
the whales, the high rollers,
tons of Chinese.
Asia's got all the high rollers, man.
They do. A lot of people here don't realize that, but that's a very, very solid and a very good point.
Yeah.
Jeff, this was a wonderful, wonderful session. We covered so many topics. I mean, we talked about inflation, we talked about China, we talked about the energy markets, we talked about semiconductors. We've done it all. Jeff, this was a great session. And folks at home, if you have a follow-up question for Jeff, please send us an email. We want you guys to benefit. We're not doing this for our health. We're doing this so you guys can benefit. Please reach out, jeff@joyofthetrade.com. That's jeff@joyofthetrade.com. My email is support@marketgeeks.com. Feel free to reach out to us. You guys have a wonderful, wonderful week ahead. And Jeff, I'll talk to you later. Have a great week. Keep your eye on the market and great session. Bye, everyone.
Thank you, Roger.
Yeah, it was wonderful. Guy. I look forward to speaking to you this time next week.
I'll be back.
Bye.
As Arnold says. See ya.
Yeah, bye. Thank you.